Having been about 2 decades in the investment management space, I never expected a conversation to reframe how I approach some investing concepts which I took for granted, like data, research, active investments. The podcast is, of course, about rethinking investment management and how tech and ideas can create better outcomes, but I didn't expect this rethink to be as radical as with the conversation I had with Marco Aboav, who comes from the hedge fund world and is now the CEO of Etna Research. The company offers to use frontier AI to accelerate alpha discovery. In fact, I was so taken with the way he approaches data and alpha that we only talked about AI at the very end, and that's something pretty crazy these days. We started the conversation with his background, and although his early career was quite typical, the rest is not. Enjoy this conversation.
I'm the typical guy that studied in Italy, moved to UK for professional reason. I joined, as many graduates after my PhD, a bank, and I've been exposed to all the structuring for the major family office in EMEA. I got the chance to meet my current business partner in a hedge fund, so I moved to a hedge fund setup later for 5 billion plus hedge funds, multi-PM, where we managed to essentially build the central risk book for the firm. My boss is my business partner now, but he was my boss at the time, so we were involved in all the research, execution, everything, technology. I got exposure as well to the digital wealth management via Money Farm, so I've been running the portfolios for a couple of years there, and I've been exposed as well there to the execution, trading, and so on. I managed to launch my hedge fund after that. I raised roughly $40 million for IML hedge funds. I use its product. And somehow all these different experiences have lots of things actually in common. The reason why we decided to launch Etna was the fact that the industry is changing to something which is much more pull approach instead of push. So we don't push products, but we build via technology any kind of solution. So we bring technologies today to funds, wealth managers, family offices, insurance, banks, no retail for obvious reason.
Wonderful. Okay, there's a lot to explore this, but first, I want to just dig a bit further into your background because you mentioned you've got a PhD. Can you tell us what kind of PhD? And my question is because I've discussed with another quant before, Christian Collins. He was saying, well, he saw an evolution in the role in the type of quants that we see in finance. Typically, the background is quant, PhD in physics and maths, and he said this has changed. So what was your original focus of studies?
I studied industrial engineering. My thesis was all about actually financial econometrics, financial time series. So it's always been my keen interest to discover how to exploit inefficiencies, obviously in a very naive way in the early days, much less computational than these days. And so it was a kind of a natural. I finished my PhD at the time, was called CAS Business School. So I spent half of my PhD there. So it was a kind of natural progression to actually remain in UK instead of going back to Italy for work. And so it's, as I said, is a natural, what I did after that was a natural progression of what I've been studying, researching for a few years.
I'm asking because, I was curious. There's a lot of people who, it seems like, they're going to physics and be a nuclear scientist and realize that banking is their career. So you've got a more natural progression. So now if we go back to Etna, you've given a list of the types of clients. So we could put them all as institutional investment managers, perhaps. That's a categorization.
Yeah, I mean, obviously, the pool of potential clients could be very broad. For obvious reason, we always try to focus on the one where, for sales cycle is fast and, we have, legacy relationship in place. But we mainly work with funds at the moment.
Right. And then those funds, they will market to a broad types of individuals, institution, and so on.
It's really mainly hedge funds. We do is a natural fit with what they're looking for, and it's also, as I said, faster from a sales cycle perspective compared to a bank, for instance.
Very interesting. And you mentioned your experience in hedge funds, and something that I've also discussed with the previous guest, the risk modeling. I've discussed with Rupa Ghosh, and one of his key points was that risk management, in fact, is the core skill of hedge funds. Would you agree with that, or what's the key for a hedge fund these days?
Wrong to compare hedge funds with everyone else. It's a very different type of animal, different type of need, different type of specialization, and level and quality of the service. The obviously is the most challenging one, but also
Mm-hmm.
potentially the most rewarding. Coming from that word for us was easier because we know exactly how people think on the other side, their concerns for any vendors out there, P&L related and so on. So it's a very tricky sub-vertical in the asset management
Mm-hmm.
space, but also the most interesting, massive sophistication and so on. So risk is part of managing risk is the key aspect, right? Capital preservation is number one rule when you talk about hedge funds versus, I don't know, VC or where it's completely kind of chasing options. So it's a very particular sub-industry in the broader asset management space.
But that's something interesting too. We're going to get to data and alpha later, but I also want to understand this because I think it's quite opaque to many people. And I guess there's two questions that come to that. Then first, you said capital preservation is paramount, but as a lot of hedge fund, as far as I can see, it seems to be more like anyway long equity bias. The second aspect is how different. You said it's a radically different thing, but it seems to me like all or a lot of traditional asset managers, they have this quantitative approach and they have some, strategies or whatever you want to call them. How is that radically different from a hedge fund?
There is definitely an overlap between some funds, some hedge funds, and what people call traditional factor investings, which is basically what we see in a lot of asset managers nowadays.
Mm-hmm.
Um, I would obviously split the faster guy, or anyway, the one that are a little bit far away from the factor investing folks or strategies. No surprise that even banks join the party with quant investment strategy groups to sell the same factors that some asset managers are trying to sell. So it's a very big crowd of people chasing certain type of styles. But obviously within the hedge funds, there is a massive dispersion in terms of strategies and types. So those that are a little bit more at the forefront, at the end of the day, is a question of risk adjusted and so on. Lots of the factor investing folks are far away from the higher sharp that you get for certain type of multi-managers or certain type of single team strategy. So again, there is a massive dispersion. It's very
Mm.
hard to generalize when we talk about hedge funds.
Right, right. There's a whole spectrum, right? Um, and so, if we go then more specific in terms of how you work with them, how do you implement your services, and how does it look before and after they adopt Etna's solutions?
So, I mean, I guess the starting point that is important to clarify here is that after MiFID II, there was a lot of earthquakes happening in the industry where, in the past, research was essentially free. Then it was split from execution. So then there was the moment where people were expecting to pay for research. Then this thing didn't happen, not at all, but, it was actually difficult to justify a certain type of pricing for the research. And so that was the moment where as well, when we are on the other side, so running money and realizing that, there was definitely a space for partners, research and AI partners that they can take that kind of role, but also enhance that role to something which is just not just PDFs,
Mm-hmm.
research out with that kind of output, but really something that is really actionable for the client. And if you think about, the traditional, what people call alpha capture, where big funds like Marshall Wace, they have, incredible success. In a way, they relied on external researchers or analysts to build very successful portfolios. So this is, to us, is a little bit kind of the alpha capsule steroids that people call it at the beginning, right? So this is kind of 2.0, where the quant allows you to build a very scalable business compared to just being one analyst giving ideas to the big guys in the funds.
So specifically, how does it work? Can you walk us through the process and what makes them decide to adopt your services and what do you bring them specifically?
Yeah, I mean, it's very simple, it's very hard, meaning the kind of clients we deal with are typically the head of research, the senior PM type of guy. So very senior, very sophisticated, running potentially billions of dollars in their books. And they're looking for someone that can build custom research and portfolios for them without essentially all the R&D drag attached, which
Got
has a
it.
cost as a capex, but also as a cost as an opex. So what is the running cost of a quant pod within a bigger pod? It's a very expensive game. We try to be essentially the research partner, the AI partner that can build fast what the PM or the CIO or the head of research is looking for. And of course, there is any enterprise B2B, there is always like a high touch, conversations between us and the clients, and we need to understand integration and so on. So think about the portfolios streaming. This is exactly what we offer to the clients.
Okay, wow, okay, that's a lot of concepts here that I like. So, first of all, the idea of streaming data, I think is quite an interesting one. But secondly, just maybe to try to rephrase it, so or maybe find a comparison, just someone, it's trying to have this outsourced CIO in the traditional management space. What you're offering is implementable research, and it's the whole thing. So it means there's data, systems, and it's integrated with the hedge fund itself. Is that a good
It's a
summary?
multiple hats. So
Mm.
you're essentially getting like a team of quants in a way via the service. You're getting people that are very sophisticated on everything computationally from a computational perspective. And of course, we know what we are selling in terms of we know the pain, how people sleep at night. And so it's very important to assess the need at the beginning and build it. And you mentioned something that is correct. So we are not reselling any data, just to be clear.
Mhm.
We just construct portfolios for the clients. So it's just a sum of weights, could be dollar weights, could be percentage weights, depending on how we structure the deal, which is not absolutely not a redistribution of data.
Sure.
It's a completely different cost. So to us, is a very simple transmission, but behind the scene, there is a lot of expertise, computational knowledge, cloud knowledge, data refinements, data acquisition, data hunting, because that's kind of what we are trying to do in a way.
Okay, that's something I want to focus on a bit more. What do we mean by data hunting?
So let's say that you want to buy some market data.
Hmm.
There are so many providers out there, and you have no idea who is a very good one or a bad one.
So are we talking about alternative data here?
It could be traditional data. The
Okay.
entire full spectrum of data is full of, unfortunately, tourists,
Is it?
meaning the quality is always assessed by the PM that is running the risk.
Hmm.
Is never assessed properly by the data vendor because the data vendor sells the license. It doesn't make the P&L out of the data. So it's always the PM side that knows even more sometimes about the data that is kind of receiving. Again, because we have been on the other side many, many years, we know exactly the pain of being on the other side and having all of these salespeople coming to us and trying to sell another fancy data sets. So the hunting, meaning filtering, knowing very well who is actually selling the data very well, if it's reliable providers. There is a lot of in the small details that unless you spent 30 years in the industry, it's very hard to be an outsider and buy data and build stuff on top. It's a very different, especially in finance. Unfortunately, it's a completely different mindset that you need. The money are made on small differences. So you have to be extremely
Mm.
conscious of what you buy, and anything that could be a bias or a noise that is coming in your systems. So it's a tricky industry to sell to financial firms because they have a very, I would say, almost an obsession for what they're buying, which is not that is very different if you sell to corporates. If you
All
have to build a
right.
dashboard, it's very easy. I mean, you're just selling to the CEOs of a SME or so on. But if you're selling to a PM that is actually making money out of the data, is a very different type of guy that you're facing when you sell a data set.
No, that's fascinating to me because it's kind of completely opening my eyes to something new because I was seeing financial data as something maybe rather commoditized from the exchange or from whatever traditional providers. But what you're telling me is that it's very different. It's not commoditized. It's actually very differentiated. And it's not about the source, it's also about the quality.
Yeah.
And is there an element of data cleaning? So they're getting something that's perhaps is not perfect and making it perfect, or you just want to source the
No,
best?
even data cleaning, which is another additional step in the pipelines, is a very important step because basically it's the only layer where you can protect your engine, right? Because if you
Mm-hmm.
get bad data and it goes inside, it's the end of the game. So there is two elements here: is the getting the right data providers. Big question mark. It's not that simple. It's not that transparent. It's tricky. And second is, okay, assuming I have all this confirmation that is enough, is good enough, and I can do all my trial experimentations, you still need to make sure that the data are, and that is, I would say, is almost like a profession for in the industry.
Mm-hmm.
Engineers is a big theme. Data platform, data architecture is a big theme because it's as important as a data scientist in any organization. So it's a key element of the value chain.
My only reference point in terms of that is the book about Renaissance technology from Greg Zuckerman, who I had as a guest, and they talk a lot about not just using the data, but not just sourcing the data, but how to make data, how people work on the data itself before feeding it in the system, and that brings two reflections in one. One is the cliche, data is the new oil, but I think there's something that you mentioned about the engine, putting the right, petrol in your engine. And the second thing, which goes back to my earlier reflection, when I was saying that everybody's data driven, and I'm talking about everybody in the investment management industry, so the traditional. But now I think I understand better that there's a fundamental difference between, let's say, a hedge fund who will have this much more strategic view of data and a traditional asset manager, which I guess most of them will use the financial data that's available to most of us. Does that make sense?
Yeah, I mean, at the end of the day, it's a game of incentives. If you know you can get paid extremely well, you become obsessed about everything you do versus like on a bigger asset manager, there is a lot of elements before defining what is your compensation. So obviously they all do a fantastic job. I know very great asset managers that not only that they do a fantastic job, but at the micro level, the PM buying the data because he's trying to extract, let's say, 20, 30, $50 million P&L from 10, 15 data vendors. He has a direct impact on the selection because he's impacted completely by this choice, right? Incentive is always a very important topic when
Sure.
we talk about quality.
And can you also paint a clearer picture in terms of who are these data vendors? Are these brands that we would know of? Obviously, we're not talking about, I would think of Reuters and Bloomberg, but I think you've got something else in mind.
No, I mean, the thing is, everybody could be a data vendor. To be
Hmm.
open about, sometimes we face in my experience over the years as well, sometimes good vendors, they got whatever acquired or stuff like that. And you see the quality going south.
Mm-hmm.
So things could change. This is even worse, right? This is not something that is forever. Sometimes you have new providers coming out that are fantastic. I guess big question mark is if you're VC backed, who knows what's going to happen when money dries up. So there is a lot of things that you have to take into account. That's why the data acquisition is a very important activity that we always try to see everyone talk about AI, but AI is a very small, time wise, is a very small piece in the equation. There is much more about platforms, ingestion, acquisition. And that's why we launched Etna Research exactly for this, because we have been building things that are very sophisticated, but they can be, we've made mistakes. I made a lot of mistakes in my career and also my business partner. It's normal, but there is a lot of expertise that you can extract from our experience, and combined with proper leverage in the cloud, there is things that it was impossible to even think about 5 to 6 years ago. On top of generative AI, which again we can talk about later, but it's just about trying to be the best research platform. And for research is not producing PDFs, but having actionable plug and play solutions to each single client in a customized way. That's our mission, being useful, fast, and cost effective. You don't want to pay the sum of the parts. You might do it internally.
Yeah, no, this is fascinating, and I want to go, of course, back later to Gen AI because we have to, and alpha because how I started it. But just to stay there a little bit longer, and I understand a lot better the value chain and what you offer, and it starts with sourcing this data. But you also talk about data infrastructure, data strategies. Can you expand on that?
Yeah, I mean, in any big funds, there is always like a team of data strategists, data platform engineers. It's the core layer one, I would say, to build everything on top. This is a very complicated activity, a very expensive activity. And even like the big guys, sometimes they struggle. We have lots of reshuffle on these teams because it's hard to crack, to be honest with you. And it was hard to crack for me as well. The difference, I guess, is that when you are in an environment where you have less the pressure of the P&L and you can build as a proper tech company like we do, it's a completely different way to embrace this concept, right? Because you're building to scale to thousands of clients. So you think in a completely different way, less tactical, less, focused on the P&L over the next 3 months and so on. So that's the hedge. So everybody would like to have what we do, but it takes years. This is the only problem, that everybody wants to have results in 6 to 12 months.
Yeah,
That's
and
the
if you are a hedge fund, you have to have results in hedge to
Yeah,
every 6 to 12 months, or you're out.
exactly. So we are exactly we solve exactly that problem. Even if you have a lot of money, you are not gonna wait 3 years to get something out. That's why we exist. It's a very simple problem that we try to solve. Complicated problems, but very very clear problem.
Yeah, and it's also bringing me back to this distinction that there is between pods, Millennium Citadel, and hedge funds. So typically, what they say is pods have the resources, infrastructure, etc. But would you say you're bringing this resource and infrastructure kind of as a service?
I I think that you can find the same sophistication of multi-managers like any big guy and a single strategy fund. The capex, let's say, so the investments in technology, data, and blah blah blah, is not necessarily bigger. It's just that it's split across. So each single pod is something which is similar to a single strategy fund. You have common resources that you might rely on, but to me, the entire concept, it's the same problem, right? So you still have to go through a massive capex, which might take a lot of time. No, poaching risk is always at the door, constantly. So you build your team, and for whatever reason, they go to your competitor after 6 to 9 months. So there is a lot of competition that doesn't allow to plan for the long term. And it happens both in the multi-pod or in the single strategy. So it's very hard, coming back to the point, it's very hard to plan 2, 3 years ahead. Very, very hard. From an engineering perspective, it's very easy to hire a trader that is discretionary, he's going to trade tomorrow morning. But if you want to run a quant pod, it's a minimum 2 years plan just to set up everything, just to have the people in, just to build the first generation of the platform. So it takes ages. And I can tell you from obviously lots of contacts we have, the reshuffle is the common path because it's so difficult. It takes so much time and people that is so difficult, and everyone is struggling to achieve.
Now, this is a fascinating insight into this word, which we don't know. It's very opaque. So, thanks for that. And also, just to solidify even more, I want to try to understand what's the alternative. So, we talked about capex, opex. If I was to build this whole thing that takes 2 years, so what do I need to build? I need to have this data source, data infrastructure, people who run it.
Yeah, I
Can you
mean,
walk us through?
in any investment business, if you want to build a quant pod, you first need to build the data platform, so hiring data engineers and the engineering side first. Then you have to hire, also the PM and so on, later all together at the same time. So it's a plan because you have to, you have notice, no, non-compete, all these kind of things.
Yeah.
So it takes, again, years just to put together the people. And then you have to work on something that fits the team, because it's very difficult to build something that everybody could rely on. In the end, there is this tendency of building your own stuff. And that obviously kills productivity, because every time if you change, you have to start from scratch, more often than not. So again, it's all different there are different cases where it works very well for us because, people don't want to wait. It's very simple.
Yeah. It relates. Have you read this book, the Man Who Sold Wall Street by Greg Zuckerman? They talk about all that, right? They talk about how people are super important, how changing is constant.
I totally agree. It's a business. It's not a fancy business. It's a work. It's like you're building a car. It's insane the amount of work you have to focus on each single details. And only the guys that come. That's why the researchers are always very appreciated, because you spend years to solve a mathematical equation. And here is the same problem. You are solving so many small problems, and you want to get something out of your research questions. That's why there is this, I mean, in Renaissance, but smart people tends to be very, very bright in trying to solve hard problems. But hard problems potentially could be giving a very simple solution, right? And that's exactly what you see in the books. Is like, you can say, oh, a regression, but how do you use regression? There is a word, there is a notion out there. You can do things in, billions different ways. But the importance is always like having a proper, rigorous research framework that has to be better than what happened in academia. Because academia is, you publish papers. If you build whatever a nice back test in a paper and you publish in a journal of finance, fantastic. I still read a lot of papers. But the obsession you have for where the data is coming from, how you are ingesting this data, how you create a portfolios, how you put this in live systems, is an order of magnitude difference compared in terms of attention to details compared to someone in academia.
I want to move to Alpha and Gen AI, but I also want to finish understanding fully how you work. So, how does it work in terms of the fees, and how do people interact with you?
Yeah, I mean, historically, research has always been sold as flat fee. Think about, economic research or
I subscribe.
fundamental research. You subscribe, you get the PDFs and so on, or the web app sometimes. And people love it to call. My concern is, if things are so actionable, why they're flat fee? We always started from an outcome-based pricing, meaning, we contribute massively to your results. And so it's not flat, it's in line with what we are building on top of what we offer. Obviously, use cases could be super narrow, super broad. It could be, let's build something which has a lot of alpha, and you want to exclude beta in any possible way, versus situation where people say, I want to have some beta exposure and I want to have something on top that, it could be a long only, it could be something which is kind of a multi-asset, but you have a kind of a bias towards 60/40. We don't make the call. This is very important. So we customize what people want, but we don't push for any. I don't sell anything which is pre-configured, which is coming from a pre-configuration. The difference is that, again, because we were on the other side and people understand that we can be the partner to solve the problem fast. We typically, sometimes there is competition in deals and so on, but at the end of the day, if you're not a client this year, maybe you're a client next year, or sometimes we refer people as well. It's an industry that everybody know each other's, and reputation is important, and being in the industry, coming from the industry, obviously has an advantage when you have to deal with this kind of situation.
Right. I understand it's customized and complex. So now let's move on to the output. And your firm obviously says that it's frontier right to accelerate alpha discovery. My question about this, what are the levers to this alpha? Is it the type of data? Is it the computing power? Is it the speed, the efficiency, something else?
So obviously the quality comes from a mix of factors. Being obsessed about data is one. Being obsessed about the quality of the data is the second. Being obsessed about having an infrastructure that is at par with some of the best hedge funds out there is number three. So it's a mix. I wouldn't say,
Mm-hmm.
oh, we use a lot of open source stuff.
Mm-hmm.
But again, coming back to the regression point that we made before, there is lots of ways to think about portfolios and risk. And having an infrastructure that allows you to build fast any idea, even the wildest idea you have, is the difference, right? Because if you want to try to do something which is a tweak compared to your previous experiment and it takes a week, it's a problem. The other problem is if it takes a week to run because you're not very good from a computational perspective, if I can run it in 5 minutes, because I'm very good in building a very massive, cluster to run all these computations. This is the business, right? So there is no magic. It's just a lot of stuff done in a proper way and based on experience, and trying to have the fastest research platform globally that can be plugged in a way to any use case, from intraday super fast, super high sharp, to something which is much more in line with a wealth management solution, a 60/40 type of thing. That's the beauty of what we've been building, essentially.
Man, it's a tough business. I keep trying to refer to the misconception or common conception about hedge funds and stuff like that. And I guess there's two things that keep to mind, like kind of a informational advantage. Oh, I use these data and I like to watch Billions, and they found footage from a
Yeah,
supermarket, from
yeah,
a
yeah.
satellite. Like, yes, they win. But also the idea that, okay, data is commodity, and oh, I'm just going to I'm just going to do a model that's so clever that's going to generate alpha. The picture that you're painting is much more real and much more complex, right?
Well, I mean, coming back to the nice example of Billions, I mean, I think one thing to mention is the fact that we don't need to be necessarily the best in the world, but
Mm-hmm.
when we go into a conversation with a potential lead, if you can get the outcome in 2 days and is good enough for them, it's a deal. So people appreciate speed and deep understanding of what they're looking for. I'm not trying to say that I'm the best in the world, because it's not true, but we know exactly what people are looking for. And if we can get something that is exactly what they're looking for, it's an easy sell. versus other situations where there are no the to move forward. Coming back to the point about the data, I mean, just to clarify, one thing that I think we are a little bit better in general is that we build a portfolio based on clients' needs and so on. The difficulty for many people is to understand how much you can extract from the market. And that question is related to the trading expertise of the business partner, because it's not just a game of percentages. I don't make 3% per year. I make a certain dollar amount per year. I make a certain dollar sharp, or dollar max drawdown. So people talk about dollars, and you have to be conscious about how things scale. You need to really go into the deep microstructure of volume participation. If I'm trying to say there are 50 million to be traded today, and the underlying is trading 100 millions per day, it's a problem, right? I consume 50% of the volumes per day. Things are key. We measure all of them, which is again a little bit more difficult if you're just a pure research, traditional research firm,
Got it. Yeah.
because you always try to sell the percentages, but we don't make a living with percentages in life. And so this is very important, because the other side, the counterparty or the client is always like about that. How much can I extract in dollar terms from the example of satellite data? If the opportunity is, let's say, 10 million and it cost me 2 million, there is no guarantee the next year is going to be 10 million, right? But if it costs me 100K, I take the bet. So people think in this way when they think about data. Or like quality, if it's super quality, but you make 10x the cost or 20x the cost, you might take the risk. But if the quality is not there, and so the results you started are not so precise, who knows, right? I'm paying 100K OpEx, and I have no idea where is gonna be my dollar projection out from there. So these are simple mechanisms that if you come from the industry, and I've been working with I work with one of the best hedge funds. It's insane the amount of mental masturbation that people have on these things, which once you are in the business, you come from there, you feel every day. Like you go even to the bar and you think about, what is the margin of the cafe out there. So it becomes in your DNA. And that's why, especially that's my experience, it's much easier for people coming from the industry selling to the same folks than outsiders, former Google, former whatever, that come in and say, hey, I have better models, everything better than everyone else. Like, yes, maybe, but you're selling to the same folks I know very well, and they don't take calls from. I wouldn't take calls because it is so complicated to be good enough that I wouldn't waste my time with someone that had never been in the industry, to be honest with you.
Yeah, and you also mentioned scale, speed, and I guess that brings me to the question of sustainability, because how long does this thing last? And if the alpha is going to be eroded once it works, is the solution to have this speed of iteration
No,
because
no,
you can
not
try
really.
something else?
No, not really. I mean, I'm a little bit skeptical in general, for instance, to factor investing, right? People say, just to give a broader answer to this question.
Sure, sure.
So people say, okay, think about factor investing. I like value. I'm a value guy. I always invest in value. Now, value had, massive drawdown over the last couple of decades, not in line with the historical averages. So what do you do, right? You are dogmatic. You have a dogmatic approach to value. What do you do? We are exactly the opposite. So we think that markets are continuously adapting. So sometimes, they have a certain tilt and so on. The question is, the moment that you try to build an adaptive infrastructure, is a much more complicated infrastructure than just taking, 100 stocks and sort them by PB, or, simple indicator. So I'm actually agnostic. I'm not dogmatic. I believe markets are inefficient in a very non-linear way, meaning It's not easy to catch these inefficiencies. The efficiency might not last. The inefficiency might be there for certain type of capital to be extracted. The only certainty here is the fact that if you don't have something which has a very strong adaptive approach, I wouldn't stick to my 60/40 forever portfolios, because everything has been built and sold as a correlation story, but nothing is related to causation, which is the big thing in finance these days: causal AI, causal inference, and so on. It's very hard to measure causality, but again, even if it's easy to measure, you are chasing things that everybody's chasing. So, it has to be adaptive. You cannot be dogmatic in finance. I don't think you can.
So if I rephrase it in this chase of alpha, in fact, what you're telling me is that adaptability is at the core of what you offer. You have to be constantly adaptive. It's not like, oh, we extract this alpha a little bit and then, oh, maybe we have to rethink. No, adaptability is the core.
Yes.
It's been interesting to see a hedge fund, I don't remember the name, but those that are behind DeepSeek, suddenly coming into the frame of this very popular Gen AI and having a huge impact. And I guess that tells a lot about the skills that are in hedge funds.
Well, I think the story is pretty clear. I mean, they obviously starting not from scratch, right? Because all the open source access is like starting from something. Second, obviously they have the resources and very good talent. What I think is always relevant when you talk about this kind of situation is people that come from hedge funds, especially the data engineer, the data people and so on, they typically are much more face that problem in a very different setup where it's very important to be extremely right. So I think I even joke on this on LinkedIn. I think people underestimate data engineers in hedge funds because there is an element of data engineering behind the scene that is massive. And so the quality of the data makes the difference at the end of the day. So that to me is a bit the take for DeepSeek. And then how much they're going to make out of that, I'm not sure. I think not much, because it's going to be essentially not like a completely private business for them, for just a way to show that they can compete, right? How you're going to use it for your own business. Generative AI is still for me a very tricky tool for certain type of quant stuff. So I would rather say that probably they wanted to be just the best, or trying to be at par with the best, with a smaller budget, but with the right team, right? The talent is there to do this kind of breakthroughs. So I'm not surprised it's coming from a hedge fund.
So the next question is also broader about the hedge fund industry. It feels to me like hedge funds have a bad press as an industry. People talk a lot about the performance, which is not spectacular. And now there's been a lot of talks about fees, etc. There's a recent report. They charge as much as they gave away, basically. I don't know if you saw this in the FT. When I hear you, I see that it's a very complex industry with very smart people, obviously being able to compete, for example, as a side project with this Gen AI that's the talk of the world. But how should we see this industry? And is it right to say that maybe we should come in defense of the hedge funds? Or are they smart people doing...
It's a very big question, right?
I could ask it in a different way. Are they just really smart people doing very complicated things, but ultimately, as an industry, the output is not great, and therefore we have to look for outliers?
I mean, to me, I'm using a definition that is typically coming from academia. Essentially, a hedge fund is a liquidity provider on top of the market makers. So they're trying to catch inefficiency to make the market more efficient. You need different actors in the industry to have efficient markets. Now, the question is if they are a systemic risk to the market. There was some discussion about fixed income strategies. But in general, I think, again, you need an ecosystem of different players. An hedge fund, if it's not performing, is shutting down, like any business. It's a very fair business, right? If you have to, you have no like government help and so on. So it's like a proper full transparent business. You have to make performance and be
Mm-hmm.
sustainable over time. So, but it has a role of, being the liquidity providers for, the entire ecosystem. Is this argument is similar to what people say with HFT. I mean, HFT they bring liquidity, they bring tighter spreads. Of course, they get paid for doing this, but without them, we could have like a market that is like 20, 30 years ago in terms of spreads, right? It's really everybody has his own role in the ecosystem. I guess the only question in general is always like if there's systemic risk. Systemic risk is something that regulators, for obvious reason, they want to assess, and they should assess on a yearly basis or whatever. But apart from that, it's just an actor in the ecosystem.
I get it, and there are kind of a social or broader impact is very clear what you said, making market more efficient and fighting very hard to do it, and some succeed, and it's very cutthroat. It makes perfect sense, and it also makes sense in this debate of passive versus active and stuff like that. And perhaps as one of the last question is, you mentioned that hedge funds could be the new active management business.
Yeah,
So
I
can you
mean, that's
expand on
another
that?
thing I mentioned on recently. If you think about the big debate, passive active. Now,
Mm-hmm.
passive active is referred to the mutual funds. So
Yeah.
active mutual funds suffering lots of outflows, and people are investing in index funds or ETFs and so on. Obviously, what is missing is the fact that you can create, customized stuff, which is not wrapped into a fund. So another big theme is, even in wealth management, is like, do you need a fund, or you need like a mix of discretionary mandates to run
Mm-hmm.
your own money, and so you don't need to buy a fund anymore. You actually can, mix your different elements, weights, or stocks or credits, and so on. So the way I see a growth opportunity for the alternative is actually similar to what we see with private equity and so on, that they are say democratization and selling to retail. I see a similar trend as well, potentially for liquid alternative like hedge funds turning into ETFs or other liquid alternative. The big mistake is thinking that you can move the entire industry into an ETF, because it's not true. There are certain strategies that can be done in that way. Others are absolutely the worst thing to do. But there is room, right? So there is definitely a room for. It's a big industry. I think it's more than 4 trillion.
Yeah, where I see when I saw this, the new active management. So yes, they can. You can some strategies. I was involved actually in the Man GLG ETF, which was
Mhm.
a kind of a Marshall Ways where
Yeah.
they can pick the idea, and it worked very well, but they couldn't sustain it. But anyway, that was one, and I saw that as Bridgewater said something. They said they were going to do something about ETFs, but I was thinking more as well in terms of rather than taking, kind of expanding the market share of hedge funds, kind of taking the market share of the active asset management, which is well, it's performing because it's the beta, but is kind of also disappointing overall as an industry, right? Then we know the comparison with active, etc. So when I saw this post of you saying, "Oh, hedge funds are the new active management," I'm imagining a world where we have beta through cheap ETFs, and then instead of having active management, which is kind of beta plus, or we try to have some alpha.
For the hedge fund guys to democratize what they can offer. Well, not the entire spectrum, but they can offer. There is a lot of things happening in US with active ETFs coming from, Alex Bridgewaters. There are lots of folks trying to do that.
Yeah,
Um, so I think it's a growth driver. Obviously, fees are going to be different, but that's what I see. That in the end, I think we're moving towards much more like a menu which you can buy on your exchange. So more ETFs from private markets to
yeah,
esoteric
yeah,
strategies that are listed. So I feel that we are moving towards having much more stuff listed,
yeah.
just create combo for the client essentially. Versus like the historical, which was all about mutual funds. You have another different system to subscribe and so on. it seems that is the trend. I mean, I'm not trying to predict the future.
I ask a question always of fantasy fintech. If we don't have any constraints, if we can just dream of something that, what could it look like? And I think there's something here that I hadn't thought about, but it makes sense from a portfolio construction point of view, right? If I've got this exposure to equity, which is easy to get, and therefore I want diversification. And you could say private equity, well, anyway, I've got a lot of debates about private equity, but is it really diversifying from equity? Basically, if there is something which is truly diversifying, then it really has a lot of value.
It's related to another thing which is called indexing, tax harvesting, and so on. So there is a lot of big teams that are playing the same macro trends. The question, and I guess even for us, is I feel that, the big question is, are we going to use Excel in 5 years? Or we're going to be much more like, talking to an assistant, building the portfolio with a technology. So coming from, again, we didn't spend much time on the agentic AI and so on. There are things that are happening in that space that are incredible, but still super early. Now, we can't disclose much about what we're doing as a kind of internal project, but the major breakthrough is, there was this game and people say, well, we're not going to use Excel anymore. We're going to use Python in the quant space. My feeling is, are we going to use Python in 5 years, or is going to be much more via text or voice? So lots of it could change massively, because customization essentially is the opposite of how the industry is built, which is about pushing a product, right? So again, I'm describing things that I've seen for a long time. I'm being an observer of the space and trying to be at the forefront of everything. Now with what we do, essentially, we say, okay, if we can build, a massive research infrastructure that can be sold as a kind of B2B, there is no limit to move even forward and say, well, at some point, who knows, you're going to have your virtual assistant that is open to talk 24/7 for whatever desire you need to create whatever the portfolio, your trading strategy, your hedging strategy for your corporates, anything that is related to that. So there is a lot of interesting teams we get exposed, but again, no speculation. It's really like what happens around us. So we see just a matter of time.
Yeah, Marco, thank you so much. I can't believe that we spent a whole conversation on the podcast in 2025 and we only talk about AI in the last few minutes. But we had a lot of, normally it goes, we should jump right into it, but it's been nonetheless really fascinating. I've discovered so much about the world of data. So I'm really, really grateful for that. It's been a fantastic experience of rethinking all that word. So much to take in. So I'm sure we can have plenty more conversation. I'm very grateful for your time. Thank you. Thank you very much for listening or watching us. My name is George Aliferis. My day job is to be the founder of Orama.tv, where we produce podcasts, typically for B2B brands in the finance space. If you think I can help you with your podcast, to launch it, to grow it, to optimize it for YouTube, for example, you'll find my contact details here. And if you want to support me with this podcast, Investology, what would be fantastic is if you're listening to it on Apple Podcast, please leave a review there. Or otherwise, you can also comment on YouTube or elsewhere and let us know what you think, or suggest an area that I should explore in the next episode.